Welcome back to the deep dive. Today, we're really jumping into something big, a core idea shaping how big money sees crypto. We're focusing on Michael Saylor of MicroStrategy and his, well, you could call it an unstoppable Bitcoin thesis.
That's right. And we're not just scratching the surface here. This isn't Bitcoin 101.
Definitely not. We want to dissect the mechanics, the financial, the regulatory, the tech side behind this massive multi-billion-dollar bet he's made.
Exactly. I mean, think about it. The executive chairman of a public company basically remakes the entire firm into essentially a Bitcoin holding vehicle. That demands a close look.
It absolutely does.
So our mission today is to get past the sound bites, and really unpack why Saylor insists Bitcoin is the one unstoppable cryptocurrency. What are the specifics, the details that make him so confident, and what does that really mean for Bitcoin long term?
And to do that, we've gathered quite a bit of material. We're looking at Saylor's own words, interviews, presentations, plus MicroStrategy's financial filings, tracking their Bitcoin buys.
Yeah, those accumulation dashboards are key. We'll dig into those.
Plus, we're looking at the bigger picture institutional adoption case studies. Think BlackRock's ETF, how that unfolded, and also what companies like Tesla did with their treasuries.
And crucially, we can't ignore the market signals. On-chain data, things like Bitcoin dominance charts, those tell a story too.
Okay, so let's get the main headline out right away. What's the absolute core of Saylor's argument?
Well, from his perspective, the main thing about Bitcoin isn't just its price going up and down. It's that he sees it as fundamentally digital property, like the ultimate digital property for
It
our
should
time.
show property, okay.
Yeah. And he argues it's built to last, to outlive basically all other digital assets. Why? Because it's immutable, can't be easily changed, it's truly decentralized, and crucially, it's getting this specific stamp of approval from institutions, which he thinks shields it from, regulatory shutdown.
Got it. So if you're listening and you want the fast track to understanding why major players, big money managers, corporations, maybe even governments are getting serious about Bitcoin, this deep dive is for you.
Right, we're trying to give you the insights to really grasp the scale of this institutional shift and what it means for investing in this space long term.
Okay, let's start with the foundation. Michael Saylor. Why him? Why does his opinion carry so much weight? I mean, there are lots of Bitcoin bulls out there, right? What makes him different?
Well, I think it's because he didn't just talk the talk. He quite literally put his company's money and future where his mouth is. He didn't just tweet about Bitcoin. He fundamentally altered MicroStrategy's corporate strategy.
Transformed it, really.
Exactly. He used the corporate structure itself as a tool to acquire Bitcoin. It's one thing to believe, it's another to engineer your entire public company around that belief. That's the ultimate proof of conviction, and it's all laid out in the sources we looked at.
And the scale is just staggering. Can you remind us of the numbers?
Yeah, the numbers are huge. Last reported figures, MicroStrategy holds over 226,000 Bitcoin.
Wow.
And depending on the market price, obviously, that puts the value somewhere north of $15 billion. It's a massive position.
And they started this back in 2020?
August 2020, yeah. That timeline is really important. It shows this wasn't some flash-in-the-pan decision. It's been a consistent strategy over several years now.
Let's talk about that timeline and the nerve it took. Because, okay, it looks smart now with prices higher, but they were buying during some pretty scary downturns too, weren't they?
Oh, absolutely. That's a critical point. The source material makes it clear this is a multi-decade bet for Saylor. It is not a short-term trade.
Right.
He kept buying consistently, even through the crypto winter of 2022, those big drawdowns. When the price was crashing, Saylor's out there raising capital, issuing debt, selling stocks specifically to buy more Bitcoin.
Buying the dip, as they say.
Buying the dip on a corporate scale, yeah. He frames every price drop as a buying opportunity for what he sees as a unique long-term asset. And maybe the most telling detail, they've never sold any of that Bitcoin.
Never sold.
Not a single Satoshi, according to their disclosures. That kind of HODL mentality. But backed by a public company's balance sheet? That's pretty unique.
Okay, but let's bring in the counter-argument here, because this needs to be said. That massive pile of Bitcoin wasn't just bought with spare cash lying around, was it? He used some serious financial engineering.
No, you're absolutely right. That's the critical pushback.
Doesn't that leverage the debt they took on kind of weaken the unstoppable idea? Critics call MicroStrategy basically a leveraged Bitcoin ETF, right? Adding risk that isn't inherent to Bitcoin itself.
That is the key critique, yes. And Saylor has addressed this. His argument is essentially that the company structure is just the vehicle to get the asset.
A means to an end.
Pretty much. They issued, hundreds of millions, even billions, in convertible notes. That's debt that can later be turned into MicroStrategy stock. They leveraged the company's ability to raise capital against what Saylor believes is a far superior asset, Bitcoin, aiming for a much higher return than their software business could provide.
So he's betting Bitcoin's appreciation will outweigh the cost of that debt.
Exactly. His defense is that the risk of not holding Bitcoin, the risk of holding fiat currency that gets debased by inflation, is actually greater than the financial risk of using leverage to acquire a hard asset like Bitcoin. He's convinced BTC's long-term gains will crush the cost of capital.
So it's not just pro-Bitcoin, it's fundamentally anti-fiat currency, to the point where taking on debt seems like the safer long-term play.
That's a good way to put it, yeah. That underlying belief justifies the leverage, in his view.
And this very public, very high-stakes strategy, it definitely made waves. It had a ripple effect, didn't it?
Oh, huge ripple effect. Saylor basically became the evangelist for corporations holding Bitcoin. He wrote the playbook. His constant talking, explaining, justifying it was crucial in getting other big companies to even consider putting Bitcoin on their balance sheets.
Like who? Who followed suit?
Well, the most prominent early examples were Tesla and Square, which is now Block. They made significant Bitcoin purchases for their corporate treasuries shortly after MicroStrategy paved the way.
So Saylor kind of normalized it.
He absolutely did. Before him, it was a really fringe idea for a public company. After his actions and his relentless advocacy, it became a legitimate strategy that boards and CFOs started discussing seriously around the world.
And you can almost draw a direct line from that corporate acceptance to Wall Street getting comfortable, right? Leading eventually to the ETFs.
I think it's a very fair connection to make, yeah.
Yeah.
When mainstream corporations start treating Bitcoin as a serious treasury asset, it massively reduces the perceived career risk for institutional players.
Right. It's not so out there anymore.
Exactly. It helps normalize it, makes it seem less speculative and more like, well, a legitimate asset. This corporate buy-in definitely smoothed the path for the conversations and regulatory groundwork needed for the spot Bitcoin ETFs to finally get approved.
Okay, so let's summarize this part for the listener. Saylor's personal conviction, backed by billions in corporate buys, even with that leverage risk, it sends a powerful signal.
A very powerful signal.
It basically tells both the big institutions and maybe even individual investors, look, a major public company is betting its future on this. Maybe the long-term case is strong enough for serious consideration.
Yeah, it's more than just confidence. It's like a live, ongoing case study. You can even track it. People often look at the MSTR stock price chart overlaid with the Bitcoin price chart.
The MXTR versus BTC chart, yeah.
Right. And you see the market increasingly treating MicroStrategy stock as a proxy for Bitcoin, often a leveraged one. This kind of validates Saylor's strategy, at least in the market's eyes, using the corporate structure for long-term leveraged Bitcoin exposure.
All right, let's shift gears now. Let's talk about the asset itself. What makes Bitcoin, in Saylor's view, uniquely unstoppable? That's a really strong word, unstoppable, compared to all the other thousands of digital assets out there.
It is a very strong claim, and it really boils down to Bitcoin's technical design and its security model. The absolute foundation is its decentralization and network security.
Which comes from?
It comes from its proof of work, POW consensus mechanism, and, crucially, its absolutely massive global hash rate.
Okay, hash rate. Most listeners probably know the term, but maybe unpack why that massive hash rate is Bitcoin's ultimate defense. What does it actually do?
Right. So the hash rate is basically the total combined computing power that all the Bitcoin miners around the world are dedicating to the network at any given moment. They're using this power to validate transactions, add them to the blockchain, and secure the whole system.
And Bitcoin's is just bigger.
Orders of magnitude bigger. Because Bitcoin's been around the longest and the economic incentives for miners, the block rewards and transaction fees are so substantial, its hash rate dwarfs any potential competitor.
Okay, so what's the security implication of that huge number?
It makes attacking the network prohibitively expensive. To pull off something like a 51% attack where you try to control the majority of the network's hashing power to, say, double spend coins or censor transactions.
The nightmare scenario.
Exactly. An attacker, even a powerful nation state, would need to acquire and operate an unbelievable amount of specialized mining hardware and consume vast amounts of energy, likely costing billions and billions of dollars just to attempt to challenge the existing honest miners.
And maybe not even succeed then.
Probably not. And the economic incentive just isn't there. The cost is astronomical, likely far exceeding any potential gain. So the network is just incredibly resilient against tampering or shutdown because of this sheer economic and computational wall. That's the core of the unstoppable security claim.
And this ties into his idea that you can't just make another Bitcoin.
Precisely. Saylor has said, and this quote gets repeated a lot, "You can't build another Bitcoin. It's a once-in-human-history innovation."
Strong words. What's behind that?
He's arguing that the specific conditions of Bitcoin's creation can't be replicated. You have the anonymous creator, Satoshi Nakamoto, who disappeared. You have the fair launch, no pre-mine, no VC allocation, no central foundation controlling it from day one.
Unlike many newer coins.
Right. Plus, you have over 15 years of network operation, brand recognition, and the accumulated security of that massive hash rate. Newer blockchains might offer, faster transactions or different features, but Saylor argues they almost always achieve that by sacrificing the core decentralization that makes Bitcoin unique and truly unstoppable.
Okay, so that's the technical and sort of philosophical argument. But this unique structure is now being validated in the real world by actual institutions and even countries.
Yes, and that adoption is the crucial real-world proof of the thesis. And it's interesting because you see validation from completely different ends of the spectrum.
Like what?
Well, on one end, you have El Salvador, a sovereign nation making Bitcoin legal tender. That was a radical move, right? Completely bypassing traditional global banking for things like remittances. It showed Bitcoin's potential utility outside the established system, and it even reportedly boosted tourism there.
A nation-state experiment.
Yeah.
And on the other end of the
To
spectrum.
the absolute heart of traditional finance, you have BlackRock, the world's largest asset manager, launching a spot Bitcoin ETF.
Which was a huge deal.
Monumental. Our sources show those ETFs just hoovered up capital. Institutional inflows hit over $1 billion within just a few weeks of launch.
$1 billion with a B.
Yes. And that wasn't retail money. That was big players getting involved. This effectively normalized Bitcoin exposure for countless financial advisors, wealth managers, people who couldn't or wouldn't touch it before.
So the biggest players are now integrating it into the system.
Exactly. BlackRock integrating Bitcoin isn't fighting it. It's absorbing it. That, for Saylor, is massive validation. It signals Bitcoin has passed the institutional viability test. It's not if it survives anymore. It's about how deeply integrated it becomes.
It sounds like the argument is shifting from Bitcoin being outside the system to becoming a fundamental part of it.
That's a perfect way to put it. Its unstoppable nature, in this view, comes from its ability to be woven into traditional finance, into corporate treasuries, even into nation-state considerations. It's becoming part of the fabric.
Okay, let's also touch on the digital gold idea, the macroeconomic argument.
Right. This is central to Saylor's thesis, especially now. He positions Bitcoin as the ultimate hedge against, the instability we see in the traditional macroeconomic world.
Meaning inflation, currency issues.
Exactly. Things like massive government money printing, quantitative easing, persistent inflation eroding purchasing power, the potential for currency debasement by central banks. In that environment, an asset with a verifiably scarce, fixed supply, only 21 million Bitcoin will ever exist, becomes incredibly attractive.
So the predictable scarcity is key.
It's paramount. Its supply schedule is fixed in code, completely predictable, unlike fiat currencies where supply can be increased essentially at will by policymakers. This programmatic scarcity makes it, in Saylor's view, a superior long-term store of value.
People call it digital gold. Why is it potentially better than actual physical gold in this role?
Well, the argument centers on digital age utility. Gold is great. It's held value for millennia. But Bitcoin, proponents argue, improves on it in key ways for the modern world.
Like what?
Portability, for one. Try moving $100 million worth of gold bars across borders quickly and securely. It's a logistical nightmare, expensive, risky.
Right. Heavy stuff.
Exactly. Bitcoin, you can send that value anywhere in the world with an internet connection relatively quickly, with final settlement, and it's verifiable on the public blockchain by anyone. Also, divisibility, you can send tiny fractions of a Bitcoin. Verifiability, it's real Bitcoin through the cryptography. Fungibility. It just has properties that make it a more efficient store of value for a digital, globalized economy.
So for institutions worried about inflation or maybe even confiscation risks with traditional assets?
Bitcoin presents itself as a non-sovereign, easily transferable, digitally native hard asset. That's the core of the digital gold narrative.
Okay, this leads us naturally to the next big question. If Bitcoin is so unique and unstoppable, what does Saylor think about everything else? All the thousands of other cryptocurrencies, the altcoins, the DeFi tokens?
I see. His view here is, let's say, quite stark. And it really hinges on one crucial distinction he makes, primarily for legal and regulatory reasons.
I think I know where this is going. This is the Bitcoin is a commodity, everything else is a security line.
That's the one. It's a simplification, absolutely, but it's a deliberate one with profound consequences for how institutions can interact with these assets.
Okay, unpack that. Why is that distinction so critical, especially for big players like BlackRock? Let's get into the weeds with the Howey test.
Right, the Howey test. This is the legal framework used by the SEC in the U.S. to determine if something qualifies as an investment contract, which makes it a security and subject to all sorts of regulations.
And the test has a few parts, right?
4 main prongs, yes.
Right.
Roughly. 1, is there an investment of money? 2, is it in a common enterprise? 3, is there an expectation of profit? And the crucial 4th one, 3 and 4, are those profits derived primarily from the efforts of others?
Okay, so how does Bitcoin fit?
Well, regulators generally agree Bitcoin meets the first 3. People invest money, it's a common network, they hope the price goes up. But it arguably fails the 4th prong. Because there's no central team, no CEO, no foundation whose ongoing work is the primary driver of Bitcoin's success or failure. Satoshi disappeared. The network runs based on the code, the miners, the node operators, a decentralized ecosystem. There isn't an identifiable promoter whose efforts investors are relying on.
But for many other crypto projects.
Exactly. Most altcoins, especially those launched through initial coin offerings, ICOs, or projects with active development teams, foundations, clear leadership structures, they very likely do meet that 4th prong. Investors are often relying on the efforts of that core team to build the network, market the token, and increase its value.
And that makes them securities, potentially.
Potentially, yes, in the eyes of regulators like the SEC. And that's the institutional killer app for Bitcoin, according to Saylor.
How so? Why does that scare institutions away from altcoins?
Because if an asset is deemed a security, it comes with a whole mountain of regulatory baggage. Registration requirements, disclosure rules, potential enforcement actions, lawsuits. It's incredibly complex and risky for a large, regulated institution like BlackRock or Fidelity.
They need clarity.
They absolutely need regulatory certainty. Bitcoin, being widely viewed by regulators as a commodity like gold or oil, offers that clarity. It operates under a different, generally simpler regulatory framework. This legal de-risking makes it vastly easier and safer for institutions to allocate significant capital to Bitcoin compared to almost any other digital asset.
So the commodity status is like a regulatory moat.
A huge one. It dramatically lowers the barrier for institutional adoption.
And this risk isn't just about the SEC, right? Saylor also points to structural issues within the altcoin projects themselves.
Yes, he argues that the very things that often make altcoins innovative, like having a core team or foundation driving development, also make them inherently more vulnerable. That centralization creates a single point of failure. If a project relies heavily on a specific foundation, or a small group of core developers, or centralized funding, well, that entity can be pressured, sued, regulated, or even just make bad decisions. They could change the token supply, alter the roadmap. There's a reliance on human leadership.
Which contrasts sharply with Bitcoin's. Well, its resistance to change.
That's the key difference Saylor emphasizes. Bitcoin's protocol is incredibly hard to change. That perceived rigidity, that ossification, is actually its greatest strength from an institutional perspective.
It's because it's predictable.
Extremely predictable. There's no CEO to fire, no marketing department pushing hype, no foundation that can suddenly change the rules. Bitcoin's trajectory is driven by mathematics, code, and the broad consensus of its decentralized network participants.
While other chains might be chasing the next big thing, faster speeds, new features.
They often do so by compromising on that core decentralization or immutability. Saylor argues Bitcoin's long-term stability comes from its deliberate pace and its mathematical guarantees, not from constant upgrades or hype cycles. And that's what institutions ultimately want in a store of value asset.
Okay, so the big takeaway for an investor comparing Bitcoin to altcoins, based on this view, is...
It's that the market seems to be increasingly valuing regulatory clarity and proven decentralized resilience over promises of faster technology or higher short-term gains.
So Bitcoin is moving away from being just a tech bet.
That seems to be the transition, yeah. It's shifting from being seen primarily as a risk-on speculative tech play towards being viewed as digital hard money, almost like a treasury-grade asset, but in the digital realm. This shift validates Saylor's core argument. For institutions, Bitcoin is becoming the only game in town for serious, long-term digital asset allocation.
All right, fascinating distinction. Let's move to section 4. Market signals in the future. We've talked theory, we've talked conviction. What's the hard evidence? Where's the data showing institutions are actually buying into this thesis following Saylor's lead?
Well, the most undeniable evidence is the capital flow, especially after those spot Bitcoin ETFs launched in the US.
The BlackRock effect and others too.
Exactly. The launch of the BlackRock iShares Bitcoin Trust, IPIC, alongside ETFs from Fidelity, ARK Invest, and others, was a watershed moment. We already mentioned the inflows over $1 billion flooding within weeks. But it's not just the amount, it's the source and the speed.
Waning.
This wasn't just retail FOMO. This was capital coming through established channels from authorized participants, likely acting on behalf of major wealth management platforms, hedge funds, maybe even pension funds dipping a toe in. It proved the institutional on-ramp was finally built and functional.
It wasn't just regulatory approval. It was the plumbing being in place for big money to flow easily.
Perfectly put. The plumbing was finally there. And beyond the ETFs, you still have the corporate treasury angle.
Right. Tesla, Block.
Yes, the fact that companies like Tesla and Block, Square, continue to hold significant amounts of Bitcoin on their balance sheets, treating it as a long-term treasury reserve asset, that sends an ongoing signal. It says, this isn't just a quick trade. We see this as part of our corporate financial strategy. That signals maturity and stability.
What about the broader crypto market data? Does it show this institutional preference for Bitcoin over other cryptos?
Overwhelmingly, yes. The metric to watch here is the BTC dominance chart.
Explain what that shows.
It basically shows Bitcoin's market capitalization as a percentage of the total cryptocurrency market cap. When institutional money comes into the space, it tends to be conservative, risk-averse, relatively speaking. They prioritize liquidity, security, and regulatory clarity.
Which leads them to Bitcoin.
Primarily, yes. So when you see BTC dominance climbing, often pushing past 54% or even higher, it's a strong indicator that new, large capital inflows are favoring Bitcoin over the thousands of altcoins. Big money isn't spreading itself thin across risky, illiquid assets. It's consolidating the perceived safest, most established digital commodity. That rising dominance is a quantitative signal of institutional choice.
Okay, so the money flows point towards Bitcoin. Now, let's look ahead. Saylor's thesis relies heavily on Bitcoin's predictable scarcity. That brings us to the halving.
The halving, yes. This is absolutely core to the unstoppable supply-side economics of Bitcoin. It's built right into the code.
Tremendous how it works.
Roughly every 4 years, the rate at which new Bitcoin are created and rewarded to miners gets cut exactly in half. It's a programmed supply shock. The next one is expected sometime around April 2028.
And historically, these halving events have had a big impact on price.
A massive impact, historically. The data suggests that major bull markets in Bitcoin tend to ignite roughly 6 to 12 months after a halving event occurs.
Why the delay?
It takes time for that reduction in new supply to really filter through the market and collide with potentially steady or increasing demand. The supply shock isn't instant, it builds. Miners have less new Bitcoin to sell, inventory gets tighter, and if demand is there, price tends to react strongly upwards.
It's incredible that this supply shock is known years in advance.
That predictability is precisely the point. It's unlike any other asset. And this predictability allows for analysis using on-chain data. We look at historical patterns.
Like what?
Well, often we see periods of consolidation or accumulation of the Bitcoin price before a halving. Smart money, long-term holders, seem to anticipate the supply shock. We can track this using metrics from places like Glassnode, things like realized cap, which shows the average price coins were last moved at, suggesting cost basis.
Or long-term holder supply.
Exactly. If you see the amount of Bitcoin held by addresses that haven't moved coins in, say, over a year, long-term holder supply increasing, while the realized cap stays steady or slowly rises, it signals conviction. It means experienced holders are accumulating, taking coins off the market, and refusing to sell, likely in anticipation of that post-halving price appreciation. They're strategically reducing the available supply.
Fascinating. Okay, let's get to the big finish line then. If Saylor's unstoppable thesis fully plays out, if institutions keep adopting it, if it functions as digital gold, what's the potential upside? What kind of price targets are we talking about?
Well, if you truly buy into the thesis that Bitcoin becomes the dominant global store of value asset, displacing a significant portion of gold's market cap and becoming a standard allocation in institutional portfolios, then the potential upside is, frankly, enormous.
Give us the numbers people talk about.
The forecasts from proponents of this view, including Saylor himself at times, often range between $250,000 to $500,000 per Bitcoin, potentially within this decade.
$500,000 a coin. That sounds astronomical. How do they justify that number? What's the math?
The math is actually fairly straightforward, conceptually. It's about market cap absorption. Right now, the total estimated market value of all the gold in the world is somewhere around $13 trillion, maybe more.
Okay. And Bitcoin's market cap is?
Currently much smaller, maybe $1.3, $1.5 trillion, fluctuating with price. So for Bitcoin to reach, say, $500,000 per coin, its total market cap would need to grow to roughly $10 trillion.
Which is still less than gold's total market cap today.
Exactly. Reaching $500 would imply Bitcoin absorbing roughly, let's say, 70–75% of gold's current market value. The argument is that as digital natives inherit wealth, and as institutions seek a more efficient, portable, verifiable store of value, capital will flow out of gold and other traditional stores of value and into Bitcoin.
So it's about Bitcoin eating gold's lunch, essentially.
That's a big part of the high-end forecast, yes. It assumes Bitcoin successfully becomes the preferred non-sovereign store of value asset for the 21st century. The ETFs provide the rails for that institutional capital to flow in. That demand meets the programmatically tightening supply due to the halving, and the price gets driven up towards those kinds of levels. It's a supply and demand story on a massive scale.
Wow. Okay, that's a powerful long-term vision. We have covered a huge amount of ground today, really drilling into this.
We definitely have.
So let's try to wrap up the core takeaways. Michael Saylor's deep, unwavering conviction in Bitcoin being unstoppable. It's built on, what, 3 main pillars we discussed?
I think that's right. Pillar 1, technical superiority. That unmatched hash rate, the proof-of-work security, the true decentralization that he argues can't be replicated.
Pillar 2.
Regulatory clarity. The crucial distinction of Bitcoin as a commodity, not a security. This basically gives institutions the green light, de-risking it compared to altcoins.
And pillar 3.
Real-world adoption signals. The proof is in the pudding, the massive ETF inflows showing institutional buy-in, corporate treasuries holding it, even nation-state experiments like El Salvador. It's being actively integrated.
Okay, a solid framework. Now, as we always like to do, let's leave our listeners with a final thought, something to chew on based on everything we've discussed.
Right. So Bitcoin has clearly achieved this incredible level of institutional acceptance. It's being welcomed into the fold of Wall Street, integrated into the traditional financial system via these ETFs. The provocative question then is this: can Bitcoin truly maintain its original ethos of being independent, decentralized, hard money now that it's so intertwined with traditional finance?
Meaning, does becoming part of the system inevitably change it?
Exactly. Does its success in gaining institutional trust subject it to the pressures, the volatility, the systemic risks, maybe even the political influences of the very centralized systems it was initially designed to offer an alternative to? Is it still truly unstoppable in its original sense, or is it now playing by Wall Street's rules to some extent?
That's a deep question.
Yeah.
Does success inevitably mean some level of co-option?
It's something worth pondering. How that tension resolves will likely shape Bitcoin's next decade profoundly.
A really great point to consider. Okay, before we sign off, if you found this deep dive into Michael Saylor's Bitcoin thesis valuable, if you enjoyed this breakdown, we really need your help.
Yeah, engagement makes a huge difference for us.
It really does. When you subscribe to the channel, when you like this deep dive, when you drop a comment below, even just a quick thought, it tells the algorithms that people are finding this content useful.
And that helps us show up for more people, helps the channel grow.
Absolutely. It allows us to keep dedicating the time and resources to researching these topics thoroughly and bringing you these kinds of in-depth, hopefully high-quality crypto insights every week, grounded in the actual source material. Your engagement is genuinely what keeps this going.
So please do engage. We really want to hear what you think. Do you buy Saylor's unstoppable argument? Is MicroStrategy's leverage a genius move or a ticking time bomb?
Or maybe the fun question: if Bitcoin actually does hit $500,000 like some predict, what's the absolute first thing you'd do? Let us know in the comments.
Yeah, let us know.
And please don't forget to hit like, subscribe if you haven't already, and definitely click that notification bell so you don't miss our next deep dive. Thanks for joining us, and we'll see you next time.